sector growth is clearly losing steam. Weak demand, muted out-of-home consumption, and margin pressures are weighing on most players even as delivery gains continue and store expansion stays aggressive. Snehi joins in with full breakdown.
Well, yes, so if you take a look at the performance from the QSR names, the quick service restaurants names in the quarter gone by, in the second quarter, overall mixed show coming in. Let me take you through some numbers. The cumulative QSR growth in quarter two was just 9.9% across the listed companies compared to 12.1% in quarter one. So sequential moderation of growth and moderation of demand is something that we've seen. The underlying demand continued to be weak. There was weak out-of-home consumption, macro softness, and GST-led pricing resets that led to some slowdown in the dine-in segment of some of these QSR names. You had names like Domino's, which is Jubilant Foodworks, KFC, which is operated by Devyani and Sapphires both, and Burger King, which is restaurant brand Asia. They witnessed improvement in their delivery mix on a year-on-year basis. However, dine-in continued to be soft. Like-for-like growth remained under pressure across brands except Domino's, that saw 9.1% growth compared to Burger King, that was up 2.8%. But these are the only two listed names in this space that recorded or registered positive like-for-like growth. Everybody else continued to be in the negative trajectory, which was the case with Devyani and Sapphire, because KFC and Pizza Hut both reported negative like-for-like growth, except Jubilant. All others saw margin declines as well due to negative operating leverage. But store expansion, that theme continues to be stable across the board. If you take a look at the same store sales growth trend, then you had positive moves for Jubilant and Burger King, but everybody else has done quite badly. And Sapphire's operation of Pizza Hut, that has seen an 8% decline in SSSG in the quarter gone by, and that is also much lower than its average of 1.5%. So well, that is the case, and overall average was lower by 1.5% in terms of the like-for-like growth. The store count continues to grow ahead. If you talk about valuations, then you have Jubilant in terms of 1 year forward EV to EBITDA valued at 22.4 times. The most expensive is Westlife, and the cheapest in terms of 1 year forward EV to EBITDA is restaurant brand Asia, the operator of Burger King in India. Other than the quarter two updates, the reason why QSR companies have recently been in the news is on the back of South Central Railways. They've requested guidelines for premium branded food outlets at stations. So this would allow names like McDonald's, KFC, Pizza Hut, Baskin Robbins, Haldiram's, and Bikaner Wala. These are the names mentioned in that circular to operate at Indian railway stations. So that's a positive for some of these companies. And other than that, you have a city note which has come recently on the QSR space, wherein they maintain their buy rating on Devyani International with target price cut to 182 from 202 earlier. And for Jubilant, they maintain a buy rating with a target price at 800 from 820 rupees earlier. So the conviction continues, but the prices have been moderated, keeping in mind what the outlook could look ahead for these QSR names after a relatively softer quarter two. So that's a roundup on why some of the QSR names have been in focus. And yes, these are all the reasons why all eyes have been on the QSR space. Yes, there has been a mild recovery in terms of stock performance, but the underlying fundamentals continue to be weak for most of the companies in the listed space.